How's it going, investors? I'm Ari and welcome to the channel. Now, if you are brand new here, stopping by for your first time, you better be a value or dividend investor because that is exactly what this channel is all about. Now, initially I began the channel back in 2019 with the intentions of just showing you all through how easy it is to hit $100,000 as long as you have a process and stick to that process regardless of if the market is up, down, or anything in between. Now, I did in fact hit my goal a couple of months ago, but given all this market volatility, here we are with my account currently sitting at $94,705.71. But these are honestly the days that I live for as a dividend investor, to just continue to double down on high quality stocks while they're trading at discounted share prices. However, in today's video, that's neither here nor there because I want to go ahead and break down all of the dividend income that I've received throughout the entire month of September, which, by the way, we just hit a new personal best in terms of dividend returns. You're going to want to watch this video through and through, but before we actually dive in, do me a favor, tap on that thumbs up button and help me grow this channel. And of course, if you haven't already joined me on the journey, go ahead and subscribe to the channel as well. I'd certainly love to have each and every one of you on the journey with me. Now, with that being said, let's go ahead and dive right in. For those of you who haven't sat through a monthly dividend income video of mine, I'm not so fond of those YouTubers out there who just drop the name of the company that paid them a dividend and then leave you with how much that company paid them, because honestly, that's pretty useless for you and not any fun for me. So personally, I'm going to go ahead and give you the company that paid me out, a tidbit of insight about that company, whether or not it's a buy in my opinion, and then wrap up with the amount of the dividend that they paid me out. And finally, at the very end of the video, we're going to go through the total in which I've received throughout the month, jump into the dividend tracker, and see how this dividend snowball rolls right along. So with that being said, I want to jump right to our first stock at the beginning of the month that paid me out. That was Johnson & Johnson, ticker symbol J&J. And Johnson & Johnson, for those of you dividend lovers out there, is just one heck of a dividend investment. And if you're a real dividend investor, Johnson & Johnson is honestly the kingpin of dividends within the healthcare industry, with over 130 years worth of revolutionizing the entire industry, whether it's with medical devices, pharmaceuticals, or just consumer care goods, which has essentially allowed for their exponential growth and the dominance within the industry as it now stands with a $437 billion market capitalization. While the stock isn't exactly undervalued at a current share price of around $164 per share with a P/E ratio at 24.2, I'm a firm believer in paying a penny or two for the safety of my dollar over the longer term, and therefore I do enjoy dollar cost averaging into the position, and I'm not going to stop doing so until I reach 100 total shares worth of Johnson & Johnson. Now, we can actually look into what hedge funds are doing, and they have currently been doubling down on J&J, which only fuels my confidence that this is one heck of a stock to continue to invest in, as we see hedge funds pouring millions and millions of dollars into the company. Not to mention, analysts are also very optimistic about Johnson & Johnson, with a target share price coming in at $186.67 per share. That's 10% worth of upside. And while I haven't bought any shares recently, I do hold 58 total shares of J&J, which allowed them to send me $62.39, given their dividend yield comes in at 2.65%. Moving to the next dividend paycheck I received, it came in from ExxonMobil, ticker symbol XOM, which I actually recently just sold out of. Now, I didn't sell ExxonMobil because I think it's a bad investment. I actually foresee that this oil and gas giant is going to perform very well for some time longer, especially as they work on becoming a greener and cleaner industry leader. However, I only held 3 shares of ExxonMobil, and I felt that it would be wiser to sell out of the position, reinvest the capital elsewhere, and double down on one of my core positions. But looking into ExxonMobil right now with a share price of $88 per share and a P/E ratio that's only at 9.7, along with analysts who foresee 30% worth of upside, coming to a stock share price of $112.78 per share, and not to mention insiders who have been scoring more and more shares of the company this past quarter. So ExxonMobil could certainly be a solid investment, and if the market really does tank and the energy sector goes bananas once again, I may very well become an investor in ExxonMobil again. As for now, I'm going to take my $2.72 for owning those 3 shares because they had a dividend yield coming in at 4.11%. Now, jumping to the 15th of the month, we had our real estate payday where I had 2 real estate investment trusts paid me out in dividends, the first of which was Stag Industrial, ticker symbol STAG, which is a REIT that was founded only rather recently in 2010 and focuses primarily on industrial properties with a major emphasis on warehouses and distribution centers. Now, I have tenants like FedEx and Amazon signing long-term leases with them, giving me tremendous confidence in their ability to just continue to deliver well into the future, especially as we head into more of an e-commerce future. Now, Stag Industrial has built a solid portfolio comprising of 559 properties across 40 states and has amassed a market capitalization of a little over $5 billion. At this point in time, Stag Industrial, in my opinion, is a REIT that's worth an add to your watch list, especially because it's down 38% on the year, trading for only $28.21. What is more is the fact that hedge funds have certainly been buying more shares worth of Stag Industrial, and analysts are even projecting 44% worth of upside, coming up to a share price of $40.63. Therefore, Stag Industrial is a REIT that I have been and will continue to dollar cost average into. As for now, I received a dividend paycheck for owning 29 shares worth of Stag of $3.58, given their dividend yield coming in at 5.12%. As for the second REIT, we have Realty Income, ticker symbol O, which is hands down my REIT of choice. And amidst all this recent market volatility, the price of Realty Income has been declining, which makes me excited because potentially I may be able to build up my position even further with Realty Income. It's a core position of mine. Now, why is that the case? Well, Realty Income is the leading net lease solutions REIT, and since its founding back in 1969, it has amassed a portfolio of over 11,000 properties spanning across all 50 states, while also growing abroad in UK, Spain, and Puerto Rico. Now, at this point in time, Realty Income also has over 1,100 clients, providing for even more reliability during these uncertain times, all of which is just allowing for a market capitalization to have grown to $37.28 billion. But as mentioned, their stock has recently been on the decline, which is currently down around 16% on the year, trading for $57 per share. Now, personally, I'd like to see it come down just a little bit more before I actually pull any triggers on it, but with some pretty prominent hedge funds like Bridgewater Associates and AEW investing tens of millions into the position, it is beginning to look more and more appealing. Not to mention, analysts only foresee growth of over 32% worth of upside, coming to a share price of $76.50 per share. As for right now, with 103 total shares of Realty Income, they sent me $25.53, given their dividend yield at 4.9%. Jumping to the 16th of the month, the world's most beloved fast food chain, McDonald's, ticker symbol MCD, sent me a dividend paycheck, which I gotta say, I'm certainly loving it. When it comes to McDonald's, I don't ever think a whole lot needs to be said. I mean, we're talking about a powerhouse of a fast food chain and a dominant real estate king with over 38,000 locations, operating in over 100 countries, and a sizable market capitalization when compared to competition, coming in at $174.32 billion. Yet amidst all of this market volatility, it's fallen roughly 10% on the year to $234 per share, which has prompted hedge funds to actually begin buying in. However, given it's not exactly an undervalued buy at this point in time, with a PE ratio coming in at 29.2, I'm comfortable just waiting for a better buy-in opportunity when it comes to McDonald's. Nonetheless, it does in fact have a solid dividend yield sitting at 2.33%, which allowed me to receive $4.81 for only owning 3 shares, and better yet, is just being a shareholder of McDonald's when the share price rises, especially as analysts foresee a rebound coming back up to $284 per share. It's about 21% worth of upside. Moving to the 20th of the month, I had my very first dividend paycheck come in from my newest holding. This dividend came in from Stanley Black & Decker, ticker symbol SWK, which is the world's largest tool manufacturer and has just been a dominant player within the industry, delivering through on top-notch brands from DeWalt to Paladin and Craftsman. Now, I recently touched upon Stanley Black & Decker in a recent video, so I won't go too crazy into detail here, but I think it's worth noting that it's down on the year by nearly 60%, trading for $77 per share. That's down from a peak of around $191. As of right now, their PE ratio is just at 13, and for all of you in disbelief that this is a quality investment, let's go ahead and take a look into what smart money is doing, because they're actually on the polar opposite end here, investing millions and millions of dollars into Stanley Black & Decker, just awaiting for an eventual rebound. which analysts are also forecasting with a target share price coming up to $107.50 per share. That's almost 40% worth of upside. Now, given I only recently began building a position with Stanley Black & Deckard with 20 shares, I received $8 given their dividend yield is coming in at 4.07%. And finally, as for my last dividend paycheck that came in from an actual stock, we have Lockheed Martin, ticker symbol LMT. It's an aerospace, defense, and information security technology company that managed to dominate its defense industry despite rather a short lifespan after being founded in 1995. Now, whether it's the laser technology or F-35 deals they're making, Lockheed is a stock that you cannot go wrong with, given their biggest client is, well, the US government, along with US allies around the world. And based on that fact alone, it's just delivering through on a lot of reliability. However, as of this moment, I don't necessarily think that Lockheed is ripe for buying and could drop a tad more in share price before I really begin to buy more. It's currently trading for $389 per share with a PE ratio coming in at 23.1. Now, I can foresee more volatility, so I'm personally not focused on Lockheed right now, though hedge funds have certainly been increasing their buying when it comes to Lockheed Martin. And on top of that, we can also see that analysts are projecting plenty of growth coming Lockheed's way, with 21% worth of upside, coming to a share price of $474.50 per share. As of right now, with a handful of shares, I received $14.29, given their dividend yield sits at 2.8%. Now, finally, I had my two index funds, Vanguard's Total Stock Market Index Fund, ticker symbol VTI, and a similar fund, Vanguard's Total Stock Market Index Fund, Admiral Class, ticker symbol VTSAX, pay me out in dividends. These funds are very similar in nature, with over 4,000 stocks within them, with a balanced mixture of small, mid, and large cap companies, as well as both growth and value investments within. So therefore, I really don't think you can go wrong investing into either of them. But I was paid $51.94 for holding 66 shares worth of VTI, and I'm eager to just continue to dollar cost average my way into this position until I get to 100 shares worth of it. And as for VTSAX, I received a whopping $86.93 for holding 225 shares. Now, make some noise here, because a grand total came in at the end of the month of September. We broke a record with $266.49 worth of dividend income. That is all passive. And even more thrilling is jumping into our dividend tracker to see the growth of this dividend snowball rolling right along. We not only have more than doubled last year's monthly income, but just surpassed last year's total, and we still have 3 months left of 2022. Of course, by the end of next month, we will be averaging now over $100 in passive income every single month, literally for just doing nothing other than being invested into high quality companies. That is the power of dividend investing. Now, investors, I'd certainly love to know how much you brought in during the month of September. What were some of your highest paying dividend stocks this past month? I want you to drop all those comments down below. Now, keep in mind, I'm not a financial advisor. Do all your due diligence following my videos, but you can do me a huge favor here in tapping on that thumbs up button. And certainly, I'd love to have each and every one of you on this journey with me. So tap on that subscribe button and join me on the journey. And until the next video, investors, I will see you all there.